All right, let's dive into one of the trickiest, most intimidating topics for any startup founder: valuation. How do you put a price tag on a dream, especially when that dream is mostly just a brilliant idea and a whole lot of ambition? Well, it's a conversation you have to have, so let's break down how to nail it.
So, this is it, the big one. How much is your idea actually worth? You spent countless nights, you've poured everything you have into this, and then an investor sits across from you and asks, "So, what's your valuation?" It feels like they're asking you to pull a magic number out of thin air, right?
But here's the secret. Early stage valuation, it's not a math problem with a single right answer. It's a negotiation. It's a story. It's about painting a picture of the future so vividly that an investor wants to buy a ticket to come along for the ride. You're not selling a company, you're selling a promise.
Okay, let's get down to the basics. What are we even talking about here? Look, at this early stage, a valuation isn't about what your company is worth today. I mean, you probably don't even have revenue yet. It's a bet. It's a shared agreement on what your company could become. Investors are buying into that potential for explosive growth.
Now, you're going to hear two terms thrown around all the time: pre-money and post-money. It's super simple. Pre-money is the value you both agree on before the investor's money is in the bank. And post-money? Well, that's just the pre-money value plus the cash they just invested. That's the new total value of the company.
Let's make this real with maybe the most famous first check in history. Peter Thiel put $500,000 into a tiny little startup called The Facebook. They agreed on a $4.5 million pre-money valuation, so you add his $500,000 and boom, the post-money valuation was a nice round $5 million. That $500,000 bought him 10% of the company. Not a bad deal, huh?
So, investors give you money and you give them a piece of the company. This leads us to a word that kind of terrifies a lot of founders: dilution. But it really shouldn't. The best way to think about it is with pizza. Sure, your slice gets smaller, but the whole pizza gets way, way bigger.
At its core, dilution is just the price of getting that growth capital. It's the fuel for the rocket ship. Yeah, your ownership percentage technically goes down, but the investment is what allows the value of the entire company to skyrocket. You end up with a smaller piece of something that's worth a whole lot more.
So how does this actually work? Let's say you and your co-founder start out with 100 shares. You own all of it. Now, an investor comes in. Here's the key. You don't sell them your shares. The company creates 25 brand new shares just for them. So now there are 125 total shares. You still have your 100, but now they represent 80% of a bigger and hopefully much more valuable company.
So how do you actually put these deals together without going broke paying lawyers? Well, lucky for us, the startup world has come up with some pretty clever tools to make this whole process way faster and a whole lot simpler.
The two big ones you need to know are safes and convertible notes. The main point of both of them is speed. They let you get cash in the door right now, and they let you kick the can down the road on that really hard conversation about the exact valuation. You basically postpone that debate until your next, bigger funding round.
Let's just put them side by side. A convertible note. It's basically a loan. It has an interest rate and it has a maturity date, a deadline when it has to be paid back or turned into stock. A safe, on the other hand, which was created by Y Combinator, is not debt. It's just a simple promise for equity in the future. No interest, no expiration date. That simplicity is why it's become so popular and is often seen as being way more founder-friendly.
Okay, so we've got the what and the how. But now, the really big question. How in the world do you pick a number? This is what I call the Goldilocks problem. You don't want a valuation that's too low, of course, but you really don't want one that's too high. You need to find the one that's just right.
Now that might sound crazy, right? Shouldn't you always fight for the highest number? Well, as Jeff Ralston from Y Combinator says, choosing too high a valuation is actually really dangerous. It sets this incredibly high bar for your next funding round and can even scare off some of the best investors before you even get started.
Think about it this way. A huge valuation feels great for your ego, but it puts insane pressure on you to hit massive goals for your next round. A fair valuation, though, it makes it easier to get the deal done, it builds momentum, and it shows investors that you see them as partners, not just walking ATMs.
So what's fair? There's no magic formula, but there are definitely market rates. You know, a friends and family round is often in that $500,000 to $1 million range. Then you get to a pre-seed round, maybe that's $1 to $5 million. And a full seed round could be $5, $10 million, or even more. This isn't a price list, but it gives you a ballpark for how valuation tends to go up as you prove out the business and reduce risk.
And you know, this brings me to what I think is the most important lesson in all of this. It's so easy to get completely obsessed with the valuation number. But here's the thing. Fundraising is not the goal. It's just the ticket to the game.
I absolutely love this quote from Jeff Ralston. When you finally close that round, you haven't won anything. You've just earned your spot at the starting line. That money, it's just a tool. The real work, the real victory, is building something amazing that people actually want to use. So let's just boil it all down. Number 1, obsess over your product, not your valuation. Number 2, a lower valuation is not a sign of failure. I mean, Dropbox raised its first round at about a $3 million valuation, and they did okay. Fighting for every last dollar of valuation is just a distraction. The most important thing is to get a deal done with partners you trust so you can get back to work.
And that's what it all comes down to. Imagine it. You've done it. The check is in the bank. You sold the promise. So what happens next? Now the real journey begins. Now you have to go out and build it.